Greetings. Today is Friday, May 23rd, and it seems that President Trump is going to get his quote-unquote one big beautiful bill. As for the rest of us, we still have one big beautiful pile of debt. On the screen right now, I've got data directly from the Federal Reserve Economic Database, sometimes referred to as FRED, and in particular, this is total federal debt as a percentage of GDP. Our debt to GDP has been rising quite substantially over these last several decades, but right now we are at 121%. That is way too high. When you spend more money than you make, you're going to create debt. That same principle applies at the national level. When the federal government spends more money than they bring in each year in terms of revenue, tax revenue, tariff revenue, doesn't matter the source of revenue, if the spending is greater than the sum total of all of the revenue, you create a deficit. That deficit must get filled somehow. That is why debt is created at the federal level. And as I just showed you, currently our national debt to GDP is 121% of GDP. That is way too high. So when you look at the federal budget, you're going to see a line item for interest payments. And this problem is about to get worse, but let me show you how bad it is already. On the screen, I've got, again, data directly from the Federal Reserve's economic database, and the blue line represents total defense spending. The green line represents interest payments on the current national debt. And you can see this number, the green number, is bigger than the blue number. So already we are spending more as a nation on interest payments than we are on total defense spending. But what you may not realize is that this calendar year, the nation has to refinance a ton of national debt because it is coming due. So it's 20 years ago, the nation borrowed money. Well, 20 years has expired and we haven't paid it off yet. The nation is going to have to refinance a lot of money this year, a lot of that debt. And as a result of that, it is going to get refinanced at a much higher rate. So this problem, which is already a pretty big one, is going to get worse. So earlier this week, the federal government had one of those bond auctions where they're trying to effectively issue new debt. It didn't go very well. On the screen, I've got a 5-minute candle chart for TLT. Remember that bond prices and bond yields are inversely related. So what you're seeing is the bond prices for TLT is going down throughout this particular day. That means the yield is going up. And what I'm trying to highlight here is effectively, I believe the bond market and bond market investors are saying, wait a minute, a crisis is coming. The reality is everybody in my industry considers a United States Treasury bond as being quote unquote risk-free. The federal government has never defaulted on their loans. There's been numerous nations across the globe that have defaulted on their loans. I go through this in my upcoming book, Evidence-Based Investing. But the reality is, yes, so far the United States government has not defaulted on our loans. That doesn't mean we won't. That doesn't mean we can't. And the more debt that we keep piling on to ourselves, the harder it's going to be to keep paying those debt payments. One of the cliches in this business is that bankruptcy happens slowly, then all at once. In other words, people that end up filing for bankruptcy they accumulate a little debt and they accumulate a little debt and they accumulate a little bit more and a little bit more and a little bit, and it happens over a long period of time, and then all of a sudden it comes crashing down. I would argue that the bond market this particular past few days ago, I would argue that the bond market is saying, wait a minute, this crisis of the United States debt, it's coming closer and closer. Is not a good sign.